Looks like I've got it. This meeting's being live streamed. Okay, I think we're live, so I will call the meeting of the Investment Committee of the Cincinnati Board of Park Commissioners to order. And we have with us members of the committee. This is Jim Getz, the chair. We have Mr. Steve Pullman and Mr. John Nyer, our current director, who is also a committee member, and Mr. Craig Sherman. Not with us, but someone who may join later is Kevin Flynn, who's a member of our committee as well. Oh, Kevin, are you there? No, I don't think so. Okay, we are called to order, and the first thing that I would like to discuss on our agenda is approval of minutes from our February 2nd meeting. Are there any questions or comments? And I had one. For some reason, the system is very different today, so I can't. There was one, I didn't understand one line in that. I don't have it here in front of me. Craig, it was something, I don't know if you've got those minutes in front of you that you can pull it up. I can't find it here on my system to pull up.
Do you know roughly kind of where it was on the minutes?
Yeah, let me find it here.
Was it one of those, Jim, that was in bold that was attributed to you, maybe?
No, here we go. It's there's under structural review and investments. It said John dash assignment is looking for a longer to see how PNC performers full set of quarters. I absolutely don't understand what that means.
Let me think about that one.
Looks
I'll
like
review that, and I'll actually go back and listen to the meeting.
Okay. I would like to just pull that sentence out, and if we could update these minutes subsequently, if you've got something to update it. But I know I would make a motion to approve with striking that one sentence.
And I will second that motion.
Any other questions or changes? If not, all those in favor of approving the minutes, say aye. Aye.
Aye.
And any opposed? Okay, thanks, Craig. Those are approved. We have guests with us. Craig, would you like to introduce our guests?
Yes, from U.S. Bank, our investment managers there, Marty and Ken, are here to provide a presentation on U.S. Bank's performance.
Good afternoon.
Welcome, guys.
Craig, thank you. Craig, before I begin, just want to confirm, did you send everybody the March performance? Because when I pulled up the Zoom meeting invite, it had December. So I just wanted to make sure I'm talking off of whatever anybody has a copy of. So
yes, they were all provided the March information. So committee, the original one I sent you was December. Just make sure that you're looking at the March.
okay, I just want to make sure so that nobody gets confused. Can everybody see my screen? I'm trying to share it.
Yes.
Looks okay.
Wonderful. So here's a brief recap of the quarter. Obviously, a lot has really changed since the end of the quarter even. But the first quarter of this year was really driven by a couple different macro things and then expectations on how the Fed is going to respond to those. So, I mean, if you recall, we actually came into the year with some serious concerns about the Omicron variant of COVID and what that was going to do because it was a lot more infectious. They weren't sure that it was necessarily less virulent, is that the proper term, which it did turn out to be, but there was concerns that, that might slow the economy and we might have some issues there. And at the same time, we were really getting some high inflation numbers, and those persisted through the quarter. March inflation, core inflation was CPI was up 8.5% year over year. The core was up 6.5% year over year. And then PPI in March was up 11.2% year over year. And so towards the end of the quarter, it looked, well, then we had, the Russia-Ukraine invasion. And so going into the Fed meeting in March, it looked like the Fed was going to probably raise interest rates 50 basis points. And then once we had the Russia invasion of Ukraine, they pared it back because of the uncertainty there to 25 basis points. And then we got the heavy March inflation numbers, and now it looks like after some speeches that several Fed governors did late last week, it looks like they're going to go. Expectations for the market are they're going to go 50 basis points May 4th, and then they may go 50 basis points June and July, and then 25 basis points the rest of the year. And that's why we've really seen the volatility that we've seen this week. So, the economy and how things are responding, how the Fed's responding to that is really what's driving this market, and it's really creating some volatility. You can see under that global inflation, emerging markets are slowing, and China's economic growth is decelerating as it's battling COVID. That hasn't gotten any better since the end of the quarter. Right now, Shanghai is on lockdown for the 4th or 5th week now, and that's creating quite a bit of anger among the population. And now Beijing looks like it may actually have to go on lockdown. And as a result of that, today, China just announced a huge infrastructure plan to try and spur their economy, because of the negative effects that these lockdowns are going to have. So that was just announced earlier today. On that second bullet point, you can see most equity indexes did fall over the course of the quarter, despite a nice rebound in March. Obviously, because of the Russia-Ukraine situation, energy was the key winner there. The first quarter of this year was actually the first quarter we've seen all 6 major indexes down in the same quarter. So there was really nowhere over the course of the quarter to hide. That's the Dow, the S&P, the NASDAQ, the EFA, developed foreign markets, the emerging markets, and the aggregate bond index. All 6 were negative for the quarter. And you can see that third bullet point, increasing Treasury yields due to the aggressive Fed policy caused negative returns there. And we saw some really, really significant moves over the course of the quarter. The 10-year Treasury almost doubled. It went up 1.21% from 154 to 275, and the 2-year went from 0.74% at the beginning of the year to 240. So it was up 1.66%, and those are some pretty significant moves. And then you can see that last bullet point. Commodities and global infrastructure were the leaders for the quarter, and we'll talk a little bit about global infrastructure here shortly. But that's just a real quick summary of kind of what was going on for the quarter, and I'm happy to answer any questions there. Okay, hearing none, page 5 of the report just shows you a summary. This is an aggregate summary of all 4 accounts. We have included each individual account's information in this report for you to review if you'd like. But all of the accounts are virtually identical. So we run it as an aggregate for you as well. And so you can see the 4 accounts combined, the total portfolio value at the end of the quarter was $7,202,253. The net realized capital gains we've taken over the course of the quarter are almost $51,000. The annual income projected on the portfolio is $112,457 with a current yield of 1.56. You can see we ended the quarter with an equity percentage of 7.51%, fixed income of 25.28, real assets 2.12, and again, we'll talk about that in a moment. And then cash is 2%. Across the bottom, the dark blue is the portfolio, and the light beige is your benchmark. And you can see we ended the quarter virtually right on top of your benchmark with two exceptions. You can see investment grade is a little bit underweight. And then we have, here it shows commodities, but that's a system limitation. We added a tactical allocation to a tier 2 asset class that we've just recently added called global infrastructure. And so we have to update all of our systems to show it as global infrastructure rather than commodities. So that's where it's falling now. So that allocation there under commodities is actually global infrastructure. We came into the quarter, we came into the year where we were overweight U.S. equities, overweight equities in general, and then overweight U.S. equities. And then within U.S. equities, we were overweight large cap, and then we were slightly underweight developed foreign, and all of that was coming out of investment grade. And then in February, we actually went neutral equities, and then we maintained the underweight investment grade and allocated that to global infrastructure. So that was one tactical change we made at the start of the year, and I think it's going to pay off. It certainly has so far with the volatility that we've seen to the downside in equities in the first quarter. So those are the changes we made, and that's the current allocation. Are there any questions?
Yeah, Ken, can you tell us a little bit more? Global infrastructure, does that include U.S.? And
yes,
give us a little bit
does
more.
include. Yes, it does include U.S. It's an active manager. It's about, right now, the portfolio is about 50% global utilities, 5% communication services, 10% energy, 30% industrials, and then 5% real estate. I can tell you that when I looked at it this morning, the biggest contributors were companies like Union Pacific, NextEra Energy, Exelon, AEP, because of what the energy sector here in the U.S. did the first quarter, right? Some of the laggers were some of the international industrials, including like Japan Railway was one of the detractors in the first quarter. So yeah, it is global, but yes, it does include U.S.
Thanks. Craig, just a quick question. Have we now completed our distributions for fiscal year 22 out of the funds already?
Yes, they have been distributed.
All right. Any other questions? All right. The next, what I do? The next two pages are the individual holdings, and I can certainly talk to any of these if you like. We are using a combination of active and passive mutual funds. The biggest takeaway on here is, we keep an eye on the net expense ratio. You can see that up at the top, 0.21% is the net expense ratio for the combined, weighted average of the funds. And we certainly keep an eye on that. We do use active managers. They do tend to be more expensive. And we expect, to get outperformance from those managers. And if they're not doing that, then we'll certainly replace those. And that's something we certainly keep an eye on. We always use the lowest cost share class that we can use for you. And if a lower cost share class does become available, we will automatically switch you to that share class. So, we have no incentive and no compensation received, from the use of the mutual funds. And it's, we try to give you the lowest share class that we possibly can. So,
Ken, I don't
any
see
questions
any.
regarding?
I don't see any
Go ahead.
outliers or major. Is there anything on this sheet that you would bring to our attention that is of note to you?
Yeah, no. The biggest thing really is the expense ratio and just making sure they are in line with their peer group. And if we're paying an active manager, we just want to make sure we're getting performance from them. And we will certainly replace the manager. We have absolutely no proprietary funds in the portfolio at all. So there's no reason for us to maintain a fund unless we actually think it's in your best interest.
It's a smaller amount of money, but I noticed the commodities
That's the global infrastructure.
broad class, but is that something like, is that gold? Is that pork bellies? Like what is, or is that just a?
No, that's that global infrastructure I was telling you about. It's classified as commodities right now because we have to update our systems to actually create a real assets category called global infrastructure. So it's utilities, communication services, energy, industrials, real estate. It's actually not hard commodities.
If I missed that earlier, I apologize. That was just,
No, that's okay. That's okay. Yeah.
I was
absolutely.
I was hoping it was gold as well, John. So.
It wouldn't be bad if it was, right? So we used to actually, as a firm, have a strategic allocation to commodities, but obviously this is really the first year we've seen significant positive performance out of commodities since probably 2012, and it's just really hard. We try not to make moves based on a 6 to 8 to 9 month outlook, but usually where we think there's some opportunity, in 12 to 18 months, and commodities can be extremely volatile, and certainly they can turn pretty quick. So page 8 of the report just shows you a 3-year risk analysis. This was a report Craig asked that we include based on some other reports you get from other managers that you liked and wanted to see. I think if you look through the numbers here, nothing jumps out of the page. You can see the yellow and the green for the total portfolio net of fees versus the benchmark. They're right on top of each other. So we're not taking any undue risk. You can see, and we'll talk more about performance, but performance has slightly lagged the benchmark, but the standard deviation is really right on top. The beta's 1.01. You can see the R squared is right in line with the benchmark. So there's nothing in terms of a risk analysis that jumps out and is any reason for concern that I see. So I would hope you concur. Page 9 is just an investment summary. And so we started the year, the portfolios combined $7,611,431.15. Net contributions to the portfolio, $4,482.30. Fees deducted, $4,482.23. And then earned income, $12,881.06. And then a decline of $420,056.71 from the market. And then you can see on a 1-year basis, net contributions and withdrawals on a 1-year basis, $118,120.09 was taken out. Fees deducted $17,840.45. Income earned of $110,650.89, and then market appreciation over the preceding 12 months, $241,970.260, for a return, a total portfolio net of fees return of $457. Any questions there?
I just have a question for Craig, following up on Jim's earlier question. Are there distributions that come out of this 7.2 million? Did they happen instead in April, or what is the timing? And answer either one. Like in the roll forward, I just don't see anything coming out other than the fees. But
yeah, I would need to go back and double check the distributions when they actually went out.
Yeah, Craig, we made a distribution. I want to say we made it. Oh no, that was last year. I'm sorry. I was thinking something else. No, I don't think we've taken distributions so far this year.
Well,
yeah, no, we have not. not this year, this was last year that we processed the distributions. I believe US Bank, I think they occurred late 2021 or in the fall of 2021.
We got a request in October of 2020, and it came in with a distribution request for another account that I didn't manage, and I forwarded the request that I didn't manage. I did not, unfortunately, forward the request for the four we did manage, and as a result, the October of 2020 distributions were late and came out in January of 2021.
So that's,
And if I jump forward a couple pages, you can see those here. In 2021, withdrawals of 259,515.
Yes. There it is.
Got it.
so again, that's, Steve, when I talk about distributions, typically I'm on fiscal years. So we have not yet declared our intent to distribute for fiscal year 23, which we won't do. The board won't approve that till May or June. So, but yeah.
Yep. It's too bad we didn't distribute a whole bunch in December.
It would have been nice, right? So page 10 of the report is just another copy of the performance, but it does include the benchmark so you can kind of see where things are on a one-year basis. Again, trailing 12 months, 5.07 net of fees versus the benchmark of 457. Over the last quarter, it was down 5.35% net of fees, right in line with the benchmark. You can see that the total equity portfolio was down, 554, and then you can see how that compares to the benchmarks. And again, Russell small cap, you can see was down 7.53. The mid cap was down 4.88, and then our foreign equity was down 556. So it outperformed both the EFA index and the EM. And then you can see fixed income for the quarter was down 556 versus the global ag that was down 616. And then here you can see the commodities. That's the global infrastructure we added. We only have a little over a month's worth of data there, but it was up, almost 6%, and that's really coming, being taken from total fixed income. So. And then here is just the history of asset growth that I showed that has the individual fiscal years. This is just nice to see what the portfolio returns were over the preceding 6 years. One down year over the last 6. We do expect to see positive returns this year. Our target for the S&P 500 is 5,060, and we're getting there at 23 times earnings of 220. Earnings for the first quarter we're still early in it. As of Friday, only 20% of companies are reported. This is a heavy earnings week, and so we'll have to see what this does. But as of last Friday, about 79% of companies were reporting positive earnings surprises. 69 were reporting positive revenue surprises, and so that if we can maintain that should certainly help. The one concern is we're only seeing a growth rate of about 6.6%, which is good, but it's certainly slowing from where we've been over the preceding quarters as we've been coming out of COVID. So we have not made any adjustments expecting there to be a recession. We still have a positive outlook for 2022, and you can see historically what some of those the annual returns have been. So any questions there? again, here's the breakdown. If you do have interest in the individual accounts, I won't spend that much time here unless somebody has some questions, but you can see, for the most part, they're right on top of each other, and we're not doing anything different in one account versus the other. So we always expect these returns really to be in line with each other, unless there's a difference in distribution timing or something of that nature. And then the last page is a fee analysis that you had in your one of your other managers' reports, and so we've created this. And so again, these are estimates in terms of the net expense is for the individual funds, because obviously we don't actually get a report on that. But using the 20 basis point fee and the individual asset class weighted expense ratios, you can see how that breaks down across the different asset classes. The fee that we charge of 25 basis points, and so the trailing 12 months all-in expenses to manage the portfolios, our fees as well as the fund managers, $33,245.
Hey, Ken, what is it that makes that expense ratio relatively higher for, that commodity bucket, the global infrastructure? And I noticed back on one of the earlier pages, even though small cap and mid cap and large cap we're basically, investing in funds, but your large cap and mid cap relatively low net expense ratio, your small cap and those commodities relatively high. What, just theoretically,
active managers versus a passive index. So you can see the large cap, we're just buying the S&P 500 index, it's 2 basis points. Same with mid cap, it's 3 basis points. In small cap, you can see we've got 2 active managers, and they're both 0.99 and 0.96.
Yeah.
In developed foreign ClearBridge, it ends, 5 symbols, it ends in an X, that's an active manager, 0.49. The iShares International Select Dividend is an index ETF at 7 basis points. So active versus passive.
I suppose sometimes you get what you pay for.
I didn't put it in this report. We actually track Morningstar's active managers versus passive managers. Let me see if I can find it here from another meeting. If I can find it, I can show you. I can find this report. Oh, crumb. I don't think I'm going to be able to find it here. Oh, wait, here we go. If I can get this. All right, let me see if I can drag this over here.
Ken's looking for that.
All right.
Can you hear me? I was just going to ask how it's going administratively with Bill. Anything else you need from the U.S. Bank team? Aside from Ken's world, just if everything's going okay in general. Anything you need us to assist with?
Everything's going great, and I was happy to see you, and I know I sent a request over about adding a couple of additional items in the presentation. So thank you for being willing to provide that information to the team here.
Yeah. Okay. All right. Well, if anything changes, let me know.
It's not wanting to cooperate with me. But to give you an idea, let's see if I can just get this half of the report. So here are the different sectors of the market, and so think of this like the lower the number, the fewer active managers that are outperforming their benchmark index. So if you look at large cap over the last 10 years, only 8% of the active managers out there have outperformed their benchmark. Over the last year, 19% have. So if I have a 1 in 5 chance, really, of picking a manager that's going to outperform the index, it's in our best interest to buy the index and pay virtually nothing in fees to do that. If you look at small cap growth and value, you can see that in the growth space, we've 76% of the managers over the last 5 years outperformed, and 72% outperformed on a 10-year basis. So there, it makes sense to use an active manager and try and get some outperformance. So that kind of is where some of that thought process comes of active versus passive management. Does that help?
Yeah, that's very interesting. I don't know that I've ever seen this chart, Ken, that hangs together.
I can print this out and send it to you and Craig to distribute if it's something that interests you. And we run this every quarter. And so obviously, if you if we start seeing mid cap growth and value, you can see 65 and 56% over the last quarter. If it starts to noticeably change, and we think we can get some outperformance in active managers in mid cap, then we'll certainly consider adding an active manager versus the index. So
that is an interesting data point. I've not seen that presented that way before. It does beg a question. I would think, at least in theory, this would correlate to your risk metrics as well. Maybe with a lag to it, but at least theoretically, there should be some degree of correlation between performance and risk and these results as well.
Yes, I mean, there is going to be some of that. Yes, absolutely.
I think my stockbroker hates me serving on this committee because every quarter I get an idea. Hey, could we look at this? Could I get to that? Like, oh, you again.
That's right. So yeah, but that really is the basis, and that's something that we monitor on an ongoing basis. So.
Thank you for that.
And then let's see. So there, fees were the last thing, and then here's our outlook, and I really just talked about that. Right now, inflation and the Fed's response to inflation is really what's going to be driving the balance of this year. And so there's really 3 scenarios that we're watching to see how they play out. I mean, the first is going to be elevated inflation persists. And that's the most likely, because right now we're seeing, the CPI is up 8.6%, but average hourly earnings right now are only up 5.6%. And so, if there's a continued push, because obviously there's a labor shortage, a significant labor shortage, and if employees looking for work continue to demand higher wages, that's a sticky inflation cost, right? Once you give somebody a raise, you can't take that back unless they leave and then you hire their replacement at a lower cost, right? So that's sticky. And so if that continues if wage pressure continues to rise and companies are able to push that through to consumers, we can continue to see some elevated inflation. We don't think it'll remain as high as it is right now, 8.6%. I think right now the analyst expectation to end the year is about 5.7%. But that's really the concern there. The Fed could they haven't proved to be tremendously successful, but could certainly thread the needle, get inflation to come down without pushing us into a recession. That's going to, we're hoping they're able to do that. And then the third option is obviously, inflation collapses, inflation reverts to normal historical levels, an alleviation of the supply chain restraints, an alleviation of some of the price pressures, and equity market, valuations stabilize, but then the Fed stops, short of the market's currently projected rate hikes, and we'll have to see if that happens, but we don't think that's the most likely scenario. And then, in that instance, corporate earnings are going to be under pressure from lower demand, and that's going to create some additional market volatility as well. So what happens over the balance of this year is really going to depend on inflation and the Fed's response to it and how successful they are, threading that needle between being too aggressive and potentially causing the market to slow more significantly than they like. I don't think the risk is that they don't act aggressive enough. I mean, right now, like I said earlier, they're pricing in the next 3 rate hikes at 50 basis points, and I think it was Powell last Thursday, or it might have been Bullard that wasn't opposed to 75 basis points in one of those 3 if it was necessary. So, that in the short term, if the Fed were to move 75 basis points on the 4th, that could, in the short term, cause a little bit of angst in the markets. But the Fed has, dramatically changed their outlook from where they were at the beginning of the year over the last, 30 days. So,
Well, Ken, I want to be mindful of everybody's time here. Based on this outlook, is there anything that you would recommend or anything that US Bank is looking at as far as a change in philosophy or investing outlook right now?
No, like I said, we will make any changes that we deem necessary, when we think so. As I mentioned earlier, in February, we went neutral equities. We added the global infrastructure to the portfolio. That was, based on the outlook we saw. And if we think there's some additional tactical opportunities, whether that's taking off equities exposure or adding to the global infrastructure, we would certainly do that. Absolutely. So,
does anyone have any more questions for Ken? Ken, you always provide a very thorough review. It was very clear, and we appreciate it getting it in advance because it always gives us time to review before you guys come on. So I thank you for that. Any other questions that anybody's got for Ken?
No, here, just thank you again for Ken and Marty for providing the presentation to us and the information.
absolutely. And if there's something we didn't include that you would like to see, please let me know. We're happy to try and accommodate that if we can. And then once this ends, I'll actually pull that Morningstar active managers versus passive manager page out and email it to everybody so you have it, and if it's of interest. So
Ken and Marty, maybe just in the future include the type of returns that we have become accustomed to in the past.
I will certainly do everything within my power to make that happen.
Okay, well, thank you guys very much. And once again, we really appreciate the work that you're doing for us. We appreciate your partnership. So thank you very much. And thank you for your time and explaining to us where we are and giving us a good overview. So thank you.
All right. Thank you. You all have a wonderful afternoon.
As well. Thank you, guys.
Thank you.
Take care.
Okay. I will turn it over to Craig if you would like to walk us through your Q1 performance report.
Yes. Did you want me to share my screen, or can everybody just follow along, or have it in front of you?
I've got mine in front of me. It's totally up to you.
Okay. Well, I'll just go ahead and go through it.
Okay.
Just sharing the screen. So we just had a presentation by US Bank, and if you look at the quarterly performance report, very similar numbers, little difference in how the weighting, which everything's weighted based on market value. So we went through theirs, and on the quarter report now, you'll see that there's like a 70-30 split in there, or information put in. That is indicating 70% is in equity and 30% is in fixed asset or cash. So that's allowing the committee to know what is that split. And then actually that'll show a little light, shine a little light when we go down to, if you look at Ball and Gainer and PNC and Fifth Third Bank, kind of why they perform the way they perform, depending on how they were set up in the portfolio. So Ball and Gainer, for them, they had a market value of $4,262,000. If you look at their 3-month average, it's at negative 5.07. So they perform, a drop in market, but they perform at the best rate. And their 1 year is 11.37, 14.59. And obviously they're at that 80-20, but they're at 81 and 19 for their equity and fixed asset cash. PNC Bank, you'll see that they're at $6,677,000. They perform the worst of all the investment managers at negative 6.41. That's due to they're invested higher in international stock. So where US Bank was at around 10%, PNC Bank was at 13%, and international stock had the largest decrease. And then they're at, for PNC, the 2.83, 8.40. That 2.83 is obviously being influenced by the PNC, the 60-40, the 63 to 70-37 was at 2.11. So that's what's driving that 2.83. Fifth Third Bank, they're at $7,725,000. They were a mixture of their, you have Hootsuite Acres, that's at 72.28. The Meyer Fund is 71.29, and the Fountain Square Fund was 71.29. So you can see the impact then on the returns is 5.9, negative 5.90, then 3, 10.30, then 9.80. Then from a market standpoint, the SP fell 4.6%, Dow Jones fell 4.1%, and NASDAQ 8.9. Yeah, the key thing I wanted to take away was the PNC performance here, and that was influenced just because of their higher rate in the international market. Any questions?
Didn't look like a lot of outliers in this or anything that's of concern to me. But I welcome John and Steve if you've got any observations here.
I think everything performed about the way the world has performed. It's interesting that, remember Jim Russell said in a down market, the Ball and Gainer portfolio and their approach would not go down as far. And in a positive market, it probably would not go up as high as others. And that seems to be true, although it's, a small sample size. They're almost a point better than the others.
Unfortunately, the upside has seemed to be more positive than what Jim might have put that expectation at. So,
yeah, my observation would be more general, and that is that I feel good about the investment policy and the structure of the funds. This has been not an unprecedentedly rough time or even an incredibly deep, but it's been relatively sharp, right, in a quarter, and we're holding up pretty well. So I feel good about the asset mix. Different fund performance goes up and down, but there's nobody who's radically out of step or who just got punished for their position. So I think you always learn more about your securities in a tougher market than in a good market. And what is it? Choppy seas make good captains. I think it's a chance to test that out. I really don't have anything that strikes me as uncomfortable or inappropriate or excessively risky. And ooh, I wish we hadn't done that. So the way to reflect that immense is to say, good job, investment committee. But I do feel good about it. I think that's been structured with some foresight, and it turns out to be a darn good thing that it was.
Okay, we'll move on.
You're muted there for the last thing you said.
It was just thank you, Craig and John.
Jim, you know that US Bank has all of our endowment at the Y.
Yeah,
And it has behaved almost identically to this portfolio. So
good. Okay, Craig.
Moving on to fees.
This is an interesting discussion here.
So for the fees, so we have the PNC Bank as of December 31st, the market value there was 7.1%. And their advisory fees were charged 50 basis points or 35,662. Investment fees 26% at 18,322, with a total fee amount of 53,984 with 76 basis points.
Craig, before you go on,
Yes.
are we looking at apples to apples there? Does this roll in the services types of fees for your checking and all of those other retail banking type things?
No. The checking and the money market account are separate from this.
Okay. That's important. So as we look at this, it was surprising to me that their advisory fees were that much more than what the others were. Has that been the case for the past few years?
Yes. PNC and Fifth Third have generally had the higher fees than the other two investment managers.
Craig, are you calculating this on the ending market value or the average for the quarter? For example, isn't US Bank is 25 basis points, right? Mathematically, this 13 may get you to 0.18. I believe we talked about PNC looking high before, and I think you don't get much of a break with them until you get to $10 million. And then they reduce it below the 50 basis points. I'm not real sure about Fifth Third. But I think we've observed this kind of about PNC in the past. I think whatever that number is for US Bank, that's a pretty good deal to have behind the curtain fees and your out front advisory fees to be only 50 basis points. That's very good. You know, I think they showed us before, Craig, like 0.46. We're showing 0.41. That's same takeaway. Does Ball and Gaynor not charge their own advisory fee?
The only thing that per their report, their information they share is just charging the manager fee, the investment manager fee, because per them, they're set up to where they're buying the stocks directly.
So that would make sense. They are the manager then. Yes. And based on the type of stuff that they buy, that's why they're, they have to charge you 50 basis points versus what US Bank is doing, I suppose. That's still a pretty good deal as well, I think.
Well, and Ball and Gainer is not a custodian. Where Ball and Gainer's funds are they over at US Bank?
That's right.
US Bank is this custodian, and US Bank charges 3 basis points.
Yeah. So that's another,
Little bit.
yeah, just a little, not a whole lot, but
Yeah, then for Fifth Third Bank, we're all aware of they're at that 73 basis points, which is usual.
Yeah. Jim, again, if you think we did this analysis and this approach a few years ago when you were involved, it looked a lot like this, and this was at least part of why we moved everything to US Bank. At least part of it. I mean, we had money at PNC, we had money at Fifth Third, and we consolidated everything to just save a few dollars. And again, because of the chart that Craig just showed us, there's nobody's out there significantly outperforming the other guy to justify a significant deviation. And having said that, these aren't way out of whack either, right? It's not like somebody's charging you a 1.25. And if instead you had this money with Bank of America or JP Morgan, that is what you would be paying. So none of this is sinful. I think it begs the question that's on the top of Craig's mind, though, about PNC.
Am I correct, and I apologize for, but it may impact Craig's answer on that, but am I correct that some of the Meyer funds, some of the funds are designated at Fifth Third? We don't have complete discretion on all of the funds. That's my recollection.
You are correct, John, where some of the funds, we are the beneficiary, but Fifth Third is the trustee. And that would be pretty much, I think it's every fund except for Levitt Clock at Fifth Third Bank.
Got it. So we don't really have a ton of latitude in Fifth Third, but structurally, we don't have any similar arrangements where PNC is the trustee there. So if we wanted to, for whatever reason, I'm not making a motion here, but we have latitude to move PNC dollars if we want to.
Yes, the Bettman account, yes.
And I apologize to the committee. I'll be back in 2 minutes, but the park board had a tree fall, and so our lot is full. I need to go get off of the street by 4 p.m. I'll be back in 3 minutes. I apologize.
please do.
Yeah, it was a pretty big tree that fell. It was the one, where the director's office is. It was just a large tree, I don't know, about 300 feet away or 400 feet. And it came crashing down in that little meadow right by the park board building. So it is a pretty good sized tree.
It wasn't the one inside the drive, right? But right by his windows, it's outside.
Yes, it's out and far enough away where it didn't come close to the parking area.
Wow.
But we had a couple pine trees that are actually slated to be removed. They're dead pine trees. So it just got them out there a little sooner versus later.
Yeah.
And one of the other things I want to kind of bring up, I know John's not here, is I did reach out to the Parks Foundation in regards to support, like what type of support does organizations provide to the parks, and PNC is the #1 supporter of all banks. So I do want to point that out.
Yeah. Well, and I appreciate that, and being on a public feed here as well, I'm very appreciative of the support that we get from all of our local banks. And but you're absolutely right. PNC has always been a very, very strong sponsor and supporter of the parks. But we always are in this committee, our fiduciary responsibility. And so, again, to Steve's point, if we were looking at somebody that was significantly out of bounds, it would be something we would take action on, whether or not the entity was a strong supporter. But in this case, I just don't see it.
Absolutely.
So Craig, I'm going to assume, I know that I would not advocate today taking any strong actions or making any investment decisions as far as allocation of funds based on the fee structures. I think it is always, I'm very glad that you keep an eye on this. And as we move forward, if we do get to that point where we think doing a difference in allocation of the portfolio makes sense, this will be a large driver of any decision like that. Steve, any other thoughts on fees before we move on?
No, I would just two things. I would agree with you. There's nothing here that warrants any dramatic action. And even though a couple are higher than a couple, this is all still a pretty good structure. These are all still pretty affordable all-in rates for management when you're adding in the manager plus the administrative / advisory fee. There's nothing that's terribly burdensome here, I don't think.
I agree. Okay, Craig, let's move on then to your distribution evaluation.
Okay. And John just returned, so.
I'm here. Sorry.
Okay. So this isn't necessarily make a request today for distribution. This is more for knowledge for the investment committee to be aware of what's available for distribution based on the 20 quarter average ending balance, and also for the 5%, also for the funds that require a 5% distribution. So for the trailing 20 quarters average ending balance, there's a total of $10,817,000 balance. So the distribution, looking at the 1, 2, 3, 4, 5%, can range from 108,000 from 1% to $540,878 for the 5%. The funds with the 5% required distribution has a balance of $9,067,000 as of December 31st, 2021. And that 5% distribution looks like $453,000. So overall, if we look at the ones with the 1% distribution plus the 5% distribution, on the low end, our distribution amount would be $561,559, all the way up to the, if it's 5% at $994,661. One thing that I haven't included in here yet is our projecting ending balances for each of these funds, and as well as the projected ending balances on with the unrestricted funds and the restricted funds overall within the commissioner's funds. So I think that's important to point out that at the end of this month and looking into May, providing those ending balances is going to be important.
Yeah, two things, Craig. Maybe more than two things, a few things. Number one, this is great information. Craig is in the middle, I'm sure, of pulling together the remaining budget figures looking at fiscal year 23, which starts July 1. We should have a better sense of city funding by the end of May. I will have a better sense of that. And then also, we don't have to make this decision today. What I would like to propose is that even if it's a very short meeting, I'd like to wait and let's schedule a meeting a month from now so that we can make a recommendation to Craig. are we doing Commissioners Fund budget in June, or you're not going to have that in May, are you? Or were you?
I was actually going to have that in July.
July. So since it's going to be in June, no, I'm kidding you. We can have a meeting to look at this, but as you point out, when you present this to us the next time when we make the decision on distribution, let's look at this also. If you would break down the top half here where we are the trustees into restricted versus unrestricted, so that we have a sense for, we don't have to, where I'm heading with this and I'm rambling, we don't have to do an overall distribution of the same amount from every fund. So if, as you are doing your budgeting, if there is limited need for restricted funds, then perhaps we distribute a lower percentage of our restricted than of our restricted, if you're following me. That would be good information to have as well as we look at what your overall needs are going to be to fill that commissioner budget.
I can
Steve,
provide that.
did that make any sense at all? That rambling there?
Yeah, I think that would be good to know, to let you know how much you have under your total discretion if you really don't need to distribute the calculated amount for the restricted portion. It would just be good to know if you're getting ready to distribute $300,000, how much of it you have for unrestricted operating type things. I think that'd be good to know. I think I should probably do the same.
To the extent that that was informed by having budget clarity, I'm concerned that that might be more in the early June timeframe than into May. I don't know that process perfectly, but I think by the time we get, my initial sense from the passing of the resolutions is I think we're going to have a little back and forth process that way. So if you want to have that clarity first, I'd suggest we do it in relatively earlier mid-June versus end of May, but I'm good either way.
Yeah, I think that's right, John. And again, I think it's Craig's call, and that's where it doesn't make sense for us to meet next until we have an idea of what his budget needs going to be out of the commissioner's fund for this coming year. So I'm flexible either way. If you want to shoot for, we can look at calendars. If you want to shoot for the second week of June, as long as we have, of June, or even the third week of June, whatever. If you're pushing, if we're not going to be taking action as a commission until July, then we're good anytime in June, so that we can make a recommendation to the board on distribution.
Probably target June 20th through the 24th, because that's a short month for the board meeting on the 16th.
So June, okay, the week of June 2024. Steve, are you in town that week? Is there anything so far on your calendar there?
On June 23rd is not a good afternoon, but the rest of the week is pretty good.
If we are keeping with our traditional Wednesday, would Wednesday the 22nd afternoon be good for you?
It is wide open currently.
And John, you're shaking your head, so I'm assuming that'd be okay. Why don't we plan that, Craig?
Sounds good.
I know we skipped ahead here too, but we've got anything else on distribution that you want to talk to us about, Craig?
Nope. I just want to provide the information to everybody, so they're aware of kind of what's coming up. And then when we meet on June 22nd, we'll have an idea of what type of distribution we may need.
And Steve, if I could, I would like to take advantage of the other three of us sort of have a pretty good idea of outstanding items and park projects. Can I take advantage of getting you one-on-one, and I can fill you in on those things to save Craig and John a little time?
Anytime. You want to do it today, or do you owe me a libation?
I'll shoot you some dates.
All right. Is there, to fast forward to the June meeting, are you thinking that there will be demands such that, Craig, you'll be heading towards a higher percentage of unrestricted distribution, or is it just too early to say? And if you don't, do you have the flexibility in, let's say that we have another challenging quarter? You know, the worst timing of making a distribution is if the portfolio is down, obviously. You know, what type of flexibility do you have, and do you think you may have?
We should have some flexibility in there because of the large amount that's sitting out there within one of the funds. That's the 60/40 fund. But like you said, yeah, it's going to be, I'll need to take a look at it and do the analysis, because one of the things I do need to look at is that Parks Commissioners item, the 4 million that's in the 60/40, because need to be mindful of that.
Sure.
Yeah, and Craig, I mean, Steve, that's a great point. Craig, as you're looking at this, we do have a lot of flexibility with this. So I think it's just one of those additional things that you should, and you're probably doing it anyway, but let's make sure that we do consider market conditions at the time. And even if we have historically or traditionally taken distributions in whatever the months were, if it was in April and September or whatever it was, none of us here think that we are the perfect market timers, but we can also take the luxury of having the flexibility and not taking everything at a certain point in time.
Yes, that's definitely something that I consider, looking at the market and understanding absolutely that if the market is down, it's definitely not the right time to make a distribution. And in the last couple of years, we've been distributing it based on when we think it's the appropriate time.
Okay, good. So, Craig, you got anything else for us, or have we? That was the end of our agenda.
That's all I had.
Anything else from our other two esteemed? John, I know you've got nothing else to do.
That's
and,
right.
Steve,
How many cards out of 100 I can get into a hat from across the desk here, but
and Steve needs to be out recruiting lifeguards, I'm sure, at this point in time.
Oh, that's a hopeless cause.
That not like I wasn't having a meeting earlier on Cincinnati Recreation Commission, which that is one of our key things, try and find qualified lifeguards for the summers.
that's a whole different barrier we're all looking at that way. That's the negative side of the inflation, or another negative side of the inflation we're seeing.
Yep. All right. Well, we've got our next meeting set, and Steve, I owe you an email, and I'm sure I'll be seeing the other two of you very quickly soon.
Looking forward to it. Am I okay to ask Tia unless Tia, are you listening?
Oh.
Yes, I'm still here.
If you, are you okay for us to?
We will stand adjourned.